So it's finally happened, as you have probably already heard or read. 2 days ago, the United States announced that it was cutting tariffs on Indian goods to 18%, down from levels that had climbed as high as 50%. Markets reacted instantly, Indian stocks rose, the rupee started to look better, and the main feeling was relief. Because it sounded like the fight with Washington and Donald Trump was finally easing. And then the details began to surface. Statements from Trump and the US trade officials say that India committed to buying more than $500 billion worth of American goods over time. In fact, why don't you listen for yourself what White House Press Secretary Carolyn Leavitt told the American media yesterday?
India has agreed to stop purchasing Russian oil to buy more American oil from the United States of America and potentially from Venezuela too. As you know, the president and his national security team are now dictating the commerce of Venezuela and those oil sales. So this directly benefits the American people as well. And in addition, India has agreed to invest more in the United States because of President Trump's call to action on that phone call yesterday. Prime Minister Modi committed to $500 billion of purchases of U.S. energy, transportation, agricultural products, and the U.S. tariff on India will now be at 18%, but American exports to India will face a tariff of 0%. So this is a great deal and a huge win for American workers, businesses, and consumers alike.
Notice what she said? That the tariff rate on Indian exports into the US are 18%. Meanwhile, India has agreed to zero tariffs on many American goods that will be entering our market. So, the early relief after the announcement is now starting to feel a bit more layered. Timing also seems to be adding to this tension. Because just less than 10 days ago, India and the European Union had wrapped up a long awaited free trade agreement after nearly 2 decades of negotiations. European leaders described it as historic, even calling it the mother of all trade deals. If you're a regular listener of Daybreak, I'm sure you remember the episode where I spoke about this deal just last week. What stood out about this EU agreement was how it was reciprocal, rules based, and designed to give India stable access to a major market over the long run. And this backdrop matters because it looked like India was finally widening its options and strengthening its negotiating position in global trade. So, why did it then give in to this deal with the US on these terms after holding out for so long? The answer has to do with where India was most exposed, how quickly the pressure was building, and what happens when tariffs are already hitting exporters. Welcome to Daybreak, a business podcast from the Ken. I'm your host Snigdha Sharma, and I don't chase the news cycle. Instead, every day of the week, my colleague Rachel Varghese and I will come to you with one business story that is worth understanding and worth your time. Today is Thursday, the 5th of February. To understand why India moved quickly with the United States, it helps to look at what was already unfolding on the ground when the talks were still underway. In the weeks before the deal was announced, the US had raised tariffs on Indian goods to levels that were described as punitive, going up as high as 50%. These were not broad theoretical threats. They were applied to duties that exporters had to price in immediately. Indian shipments entering the US market was suddenly more expensive, less competitive, and harder to plan around. News reports from the time point to pressure across a range of sectors, from textiles and jewelry to engineering goods and industrial products. Exporters interviewed by Reuters, for example, spoke about cancelled orders, margin pressure, and growing uncertainty about whether contracts signed months earlier still made sense under the new tariff regime. And this matters because of where the US sits in India's trade map. The United States is India's largest export destination, particularly for high value areas such as IT services, pharmaceuticals, textiles, and manufactured goods. And that concentration means that trade disruptions show up quickly. not just in export data, but in currency markets, stock prices, and general business confidence. In fact, the signals began to show almost immediately. After Donald Trump announced the tariff cut to 18%, there was a relief rally in the Indian markets. Stocks moved higher, and the rupee looked like it was recovering after consistently hitting all time lows in the recent past. Analysts, quoted in some news reports, noted that even though details of the deal with the US are still vague, but the pause in escalation itself carried weight. That reaction highlights something important. Markets were responding to the removal of pressure more than the promise of future gains. Now, let us compare this with the EU trade deal, which concluded after nearly 2 decades of negotiations. News reports described it as historic, with tariff reductions and market access designed to roll out over time. The structure of the deal was deliberately gradual, which means phased cuts, sector specific timelines, and long implementation windows. This is exactly what I explained in last week's episode. Do go back and listen if you missed it. So, yes, this made the EU deal significant, but also it meant that it could not immediately absorb disruptions elsewhere. Trade flows do not redirect overnight. Supply chains cannot be rewired within weeks. Adding to this urgency was the tone coming out of Donald Trump's Washington. Reuters, in a column, noted how US officials had left the door open to expanding tariffs into additional sectors if the talks stalled. And this obviously increased the uncertainty and fear for exporters who were already dealing with higher costs. All of this formed the backdrop to India's decision making. The EU deal expanded India's long term options, but the US situation was shaping day to day risk. But what this still does not explain is the shape of the agreement itself. Why do the commitments with US as we know them so far look the way they do, and why is the balance looking so uneven? Stay tuned to find out. Once you look closely at the commitments, the structure of the deal starts to make sense. This agreement was not designed like a classic free trade pact where both sides gradually lower tariffs and bargain over rules. Instead, what has been described publicly about this deal looks more like a pressure release arrangement built around where India buys, what it buys, and how closely it aligns. Like we mentioned earlier, Donald Trump and multiple White House officials have said that India will commit to more than $500 billion in purchases and investments in the US economy. This would include energy, defense equipment, aircrafts, electronics, pharmaceuticals, and technology. Now, if you think about it, these are sectors that create long term contracts, long supply chains, and long political memory. And energy is central here. India has agreed to reduce purchases of Russian oil and shift demand towards suppliers, including the United States. Trump also spoke about India buying oil from Venezuela, a country whose oil and energy reserves are now tightly controlled by the US. And this detail matters because oil sourcing is not just about markets and commerce. To put it quite bluntly, this means that India's energy security is now more closely tied to Donald Trump's geopolitical whims and fancies. And then there is the issue of market access. US Trade Representative Jamieson Greer and Carolyn Leavitt, whom you heard earlier, said that India would lower tariffs to zero on a wide range of US goods, calling the access unprecedented for American producers. Greer, however, later clarified that India would still protect some sensitive agricultural products like sugar and rice, a caveat that Indian media quickly seized on, noting the lack of clarity around which goods are now included and how fast changes would happen. Now, look at what US offered in return. Washington agreed to lower tariffs on Indian goods to 18%. But that figure looks generous only when separated from context. Multiple news reports repeatedly described the earlier tariff levels, which had climbed to around 50% as penalty tariffs imposed during a period of escalation. The move to 18% eased the pressure, calmed the markets, and kept tariffs firmly in place as a tool for the US. And this difference explains the shape of this deal. On one side, India's commitments are specific and durable. purchases, sourcing decisions, and tariff openings that are hard to reverse once implemented. US, on the other side, has made commitments that rely largely on tariff settings that remain adjustable. So ultimately, this deal goes on to reflect a negotiating dynamic where the US uses trade access to pursue their broader strategic alignment, not just commercial balance. So, when you look at it this way, the imbalance is not accidental. It is leverage, America having more leverage, at least for the near future. That the US is India's largest export market is an exposure that has been already established. Tariffs made it visible. The agreement that followed reflects that reality. One side offering certainty and the other preserving its own flexibility. And that is why this deal looks the way it does. That does not mean that the EU deal is irrelevant, and it does not turn this into a simple story of winners and losers. Basically, Europe represents where India is headed, and the United States represents where India still has to manage risk. And that is why, even after the mother of all trade deals, this US deal happened the way it did and when it did. If you have any thoughts on this topic, please do write to me at podcast@theken.com, or you can also leave comments on our YouTube channel. Thank you for tuning in, and we will catch you tomorrow.
Daybreak is produced from the newsroom of The Ken, India's first subscriber-focused business news platform. What you're listening to is just a small sample of our subscriber-only offerings, and a full subscription offers daily, long-form feature stories, newsletters, and a whole bunch of premium podcasts. To subscribe, head to theken.com and click on the red subscribe button on the top of the website. Today's episode was hosted and produced by my colleague Snigdha Sharma and edited by Rajiv CN.